Hey, welcome back, everybody, to today's Market Explained, a four-star podcast experience. This is our January 31st episode. A lot has happened this month. Been a big, important month in America with a change in leadership, a very sad plane crash, and then, of course, a Fed meeting. So there's a lot to talk about. And I'm Brian Castle, I'm your host, and I want to welcome my co-host, Mr. Christopher Reardon. Chris, welcome to the podcast.
Thank you, Brian, and good afternoon to everyone. And glad to be here and to talk a little bit about the markets.
Excellent. Well, Chris is our director of development at Star, and he's the master of all portfolio things and development. He works with advisor development as well, and he's a Cleveland Indian fan. He's a dad with three young kids. So, welcome, Chris. It comes with the whole clan with him. So welcome.
Thanks, Brian.
And I'm Brian Castle. I'm the founder and CEO of Star Wealth Advisors. I'm a financial advisor, and I'm an advisor to CEOs and insiders. I'm also a trustee of the National Boy Scout Foundation. And most importantly, I'm chief dad to Evan and Quinn, and chief husband to the amazing Trippy. We look forward to having you on the show today, everybody, or joining us for the show today. And if you can, the best thing you can do is send a copy of this episode to a friend as we increase our viewership and listenership, because you can see it on YouTube and you can hear it, of course, in any of the podcast series. That helps our numbers. It helps everything with regard to the show. And also, give us a 5 out of 5 if you would. So, Chris, we start our January 31st episode. Why don't we talk a little bit about where the markets are now? Big changes from last year. So where we are now, and let's relate that to where we've been.
Yeah. Yeah. So just, I know the last podcast we did kind of a recap of where things went in 2024 from an asset class perspective from the start to finish. So for this one, we thought, hey, let's do a catch up. Where did the asset classes start the year? Where are they now? And how have things changed? So domestic equities started the year at number one, and it still maintains that number one positioning. It's only lost 2 points, and it's at 327 tally points. So it's obviously losing 2 points, but it still remained relatively stalwart in that number one position. In the 2 and 3 position, though, we've had a bit of a shakeup. The biggest winner really so far in January has been commodities from an asset class perspective. Commodities gained 42 points from the beginning of the year, and it's at 265 tally points. And it started the year in the number 3 position. It now has kind of firmly taken control of that number 2 position. So commodities was really so far at least, the big winner. International equities on the flip side dropped from the 2 position to the 3 position, and it's lost 12 points from the beginning of the year. So not as drastic of a movement, certainly a movement backwards though there. So it's at 212 tally points. And I would say for the most part, I would say is kind of firmly entrenched in that number 3 position now. We've really seen some separation now between commodities and international equities. So cash is still in 4th. That's how it started the year. -5, so not a whole lot of change there. It's at 128 tally points. And then in the 5th and 6th position, we've seen a little bit of a swap here as well. Fixed income moved from the 6th position to the 5th position, and it lost 8 points, so -8 points from the start of the year. It's at 80 tally points. So once again, pulling back, but still moved up in a position. And that is all due to currencies, which moved from 5 to 6, so dropped 1 position point there. And it lost 12 tally points from the start of the year and is at 78 tally points total. So, not necessarily fixed income moving upwards, such as we saw in like commodities, but more fixed income lost less than currencies, and that's why it kind of gained. But those are very close. I wouldn't say either is really firmly entrenched in one position or the other. They could jostle back and forth over the next couple months, but definitely a lot of movement, and we'll see. I mean, it's been a bit of a shakeup, I would say, just volatility wise to start the year so far.
Yeah, that's interesting. That commodity move is really quite striking. So, Chris, let's drill down on that. What was in that commodity move so far?
So, I mean, we've seen that some base commodity movements. I mean, oil, and a lot of these commodities have had moments where they've been up higher, and have pulled back. That's just kind of the trends that happen within commodities, even within a month. Oil certainly had some stronger weeks. I think about net in the first month, it's up about 3-4%, within that first month. So not a huge movement there, that we've seen so far. Same with precious metals. They're up about 6 or 7%. So once again, net, we're seeing some slight movement upwards. The biggest movement really came in the agriculture sector. And you really have to drill down when you're dealing with agricultures, and mostly in coffee. Coffee's been one of the heaviest movers so far this year. I think in the last 3 months, coffee's up about 49%. Within the last year, it's up about almost 80%. So particularly Arabica coffee, that's what the 49 to 80% is relative to, but coffee in general has been up very strong. So, I think in this ag sector, and a lot of that's due to adverse conditions we've seen in Brazil, South America, where, we get predominantly Arabica coffee from. So, there's really been some, I would say, micro trends, but trends within the underlying overarching commodities, ag areas where we've seen things move. And then, the other thing I'll also kind of point out is, I think international really did weaken in the last over the last month. We've really seen some weakness out of, which we'll talk about, India and certain other markets. And I think international took a little bit of a hit too, with Trump coming into presidency. He's talking more about tariffs, things like that, as far as trade. So we've really seen that impact. And when that happens, if markets are pulling back, even if it's pulling back 5 or 6%, commodities are gaining, even if it's, call it 5, 6% as well. We're going to see just a drastic movement there.
Yes. So it's interesting. Commodities had this big move, and international's trading, and then some things are changing down below as well. With cash moving up, but that's a position change over current or in currencies, and fixed income. It's no longer in the last position. Is that right?
Yeah, no, fixed income's no longer there. But as I said, I mean, it's 2 points away from the last position. So I wouldn't necessarily say it's kind of, come out of the cellar, if you will. It's still right there. And depending on how the weeks go, or news flow happens, and we could easily see fixed income next week go back to the last position. So that definitely, I would say, they're pretty much even. But the jostling back and forth, fixed income did make that move up, I guess officially.
Right. Well, and so Chris, last year was another year where the tech stocks did well, and the so any index that had a lot of tech in it, so like S&P did very well. The dividend stocks did okay, not as well, but this year, that's so far for the first month of the year, that's changed. So the S&P is up about 3.9% right now. And that's the kind of the main index. It's what we call the main stock market. Russell 2000, which is the small cap stocks, they're up about 3.8%. So about the same, not too much different. And the Dow Jones Industrials, which is generally dividend stocks, with a few growth stocks in there, that's up 5.5%. So that's a little different, right? So the dividend stocks are working a little better. And then the NASDAQ Composite, which is a very distorted technology laden index, that's actually the weakest of all. It's 3.18. So tech was hot. We had a hot week, and then it came down. Now it's rallying a little bit again, but it's still only up 3.18. And so far, year to date, it's the worst performer, but only by a smidgen. And last year, we mentioned on a previous episode of the podcast that the equal weighted indexes significantly underperform the market cap weighted index. And so we haven't seen much divergence there in this first month, but we'll see how that plays out. Whether if this is a year where the technology stocks aren't as strong, well, then the equal weighted index could quite easily beat the market cap weighted index. And a lot of people will, not understand all of those things. Everyone thinks you have to beat the S&P 500, but a year like last year, it was very hard to beat the S&P 500 unless you had an inordinate amount of these tech names, which is actually a pretty risky position. And so for a prudent investor, maybe you don't do that. And most investors buy stocks on an equal weighted basis. And so that's that would say you follow the S&P 500 equal weight. But last year, it way underperformed the index. So the index was running. And if you want to be in it, you got to be in it, but then you got to figure out when to get out as well. So it's a little bit of a high wire act, isn't it, Chris?
Yeah, I mean it's definitely tough, and I would say it's only been really compounded. Really, I would say, I mean, before it was also an issue, but since the pandemic, we've really seen names like, as everyone heard, NVIDIA, the Facebooks, the or Meta now, I guess you could say. You've seen these names that have really taken over the market. Tesla, obviously, and that's continued. Obviously, I think last year, obviously, that the big component that was driving that was AI, and that's been shaken up a little bit so far this year, which we'll talk about. But the biggest thing when you look at between kind of the S&P 500 that I look at, and when you're looking at that pure S&P 500 or not even the equal weight versus even a Dow Jones or an S&P 500 equal weight is, a lot of that is based on future expectations or projections. It's not necessarily right now. I mean, you're not, when you look at Tesla, when you look at Meta, any of these, I mean, these aren't considered these high dividend paying cash flow. Tesla, a lot of these are barely making any money, if you will, and their price is so high and it keeps running because the expectation is they're going to continue to gain market share and continue to evolve and continue to. So, when you have stocks like that, any news, any earnings that deteriorate that potential have a dramatic effect on that stock. So that's hence why they tend to be more volatile. And once again, any news that came out can have a really big effect on the market. And as we said, with some of the stuff out of China that happened, that's why we've seen what we've seen so far for the most part this year.
Think NVIDIA was down that one day, that Monday of this week, more than any other stock that's ever been down, over 500 billion in one day.
Yeah, I think it was like 500 or 600 billion. It was in that market. Yeah, it was like the largest loss, single day loss in, I think, US history or stock market history.
So that was quite a crazy day. And that's when, the tech stock started out well, and then the big reversal that one day, and now it's been kind of sloshing around. So they're not as performing as well. Chris, the markets generally though are kind of up on optimism in general. New administration coming in, and the general thought is that the economy will be better. The general idea is that President Biden didn't get reelected because the economy was weak. That was people's overriding issue. There the border and other things like that. But the markets really and the economy are really the reason for the most part. And many are claiming the markets are too expensive right now, Chris. But now we've had the beginning of our earnings season, and earnings are coming through pretty well, right? So America's still the leading economy in the world. So we'll see how long it takes maybe the earnings to catch up to the market multiple, and there'll be a divergence, a convergence together. We were at a multiple of over 21 times, which is near an all-time record of 23 times earnings. So now, if the earnings keep running, then the multiple could potentially go down. So anyway, now Chris, you had a lot of thoughts on the markets and then the economy as well, and I wanted to share all that with our guests.
Yeah, so I mean, one thing I think it's important to point out, I mean, obviously the Federal Reserve, they met this week, and they held interest rates steady. That is going to be a prime driver of the markets this year, just like it was last year, as far as what the Federal Reserve does. In this year, more than any, it's the expectations of, are they going to lower interest rates at all? How many times are they going to lower interest rates? So there is this magnifying glass that's really put on economic data that comes out. What impact is that going to have on the Fed, and what's their posturing? And that's going to be a big driver of the markets, and it's going to cause a lot of volatility around those meetings. So we've already seen that this year, even for ones that are baked in, there still is these long odds kind of people that are saying, hey, maybe the Fed will lower rates. Maybe there's going to be kind of a one-off. Who knows? So you still see this volatility kind of spread out within the market. So, but I think some of the things, like Brian, like you said, with the new administration coming in, and I think it's widely seen as being business friendly. Republicans tend to have that kind of tilt to them, be more business friendly, less regulatory. And I would say as most people have seen, the last couple of years, the markets outside of 2022, markets have been relatively strong. But it's important to, really dissect that and look at, as far as what's driving the markets then, and I think most of what the prior administration was doing was a lot of people considered over-regulating certain things, which, and having restrictions, things like that. So I think a lot of people are looking at that, but I think the X factor, if you will, is also, not only do you get that wave of, regulatory rollback potentially, but you also have to look at what's called they call Doge, this committee that is supposed to be cutting a lot of, which is good. And we've talked about that. We want to shore up the US budget because the deficit is just at unsustainable levels. And I don't even know if it's going to be very difficult to get out of, if it's even possible. I mean, the drastic cuts that would have to be taken, but that will have an impact. I mean, you're talking about whether good or bad or whatever you want to call it, that is money that was going to the markets to pay people to whatever that's going to be taken out. So we could see that short-term volatility, how these cuts ripple through, have an impact on the economy this year. It'll remain to be seen on how they can do this and how quickly it can be enacted. So there are some X factors and some variables there for sure. But I see that kind of tug of war really going on right now, which is interesting. And then the last thing, which we kind of alluded to in the beginning, but that I'll mention is what came out. I think it was Monday or really over the weekend, I guess, this year or this week. So kind of last week of January was this Chinese company, DeepSeek, came out with an AI. And the claims of the AI was it was like a tenth cheaper than the current iterations of AI, that we've seen, Microsoft's, all those. And that, as Brian said, NVIDIA lost like 500 to 600 billion in market cap. We saw, semiconductor stocks and AI related stocks essentially down almost in some cases 15 to 30% in a single day. So obviously we saw heavy movement here. And I think it's important to note, why that did occur. A lot of these companies were being bid up or their prices were going up because the expectation that this AI was going to come in. Not only were we going to get productivity gains, which should still be there, but you were also going to get this underlying kind of investment channel that you could. So, a great derivative play, if you will, or a great kind of side play would be like Salesforce. How can they incorporate, AI into their system, then charge their customers extra for it, and then have them that benefit them, from a sales platform, things like that. So, when you get this, fed into there, if there's cheaper alternatives, things like that, that's going to really draw back that cash flow, that potential out there. So we've really seen that, I think, cause heavy ripples, I would say, through the tech markets to really start the year. I think, as we've talked about on this podcast, anything coming out of China, you have to take with a slight grain of salt. I know Sam Altman, who's a leader in AI, has looked at it, several others, and they said it is the real deal. It's impressive what they've been able to do. So I think there is credibility to it, but we'll still have to see how that plays out. And that could have a drastic impact, especially on the tech sector, the semiconductor sector, and all that moving forward in 2025. So it'll be really interesting to see.
And then, that Doge committee is really not a committee anymore, Chris, because it looks like Vivek has left the Doge committee. And I think there were some style differences. Elon Musk is just a business slasher, where Vivek is much more of a political player. And so, it's different than it was, but nonetheless, apparently Vivek is going to run for governor of Ohio. That's what we're hearing. And so now Elon Musk is still there. He really likes Trump, and they're working together on cutting spending. They've already done a bunch of things this week. They, made a move, cutting some transfer payments, and then they got kind of ahead of themselves a little bit, so they had to pull back on some of it. But they they are definitely going to try to cut spending. Whether they can cut 2 trillion, Chris, or not, I don't know. I mean, there's not a lot of discretionary spending in that budget. There's a lot of automatic spending, which is part of the issue, that we're running up such big debts, and a lot of it's automatic. It's almost like we can't settle it,
Mhm.
So anyway, so we'll see how things go. The economy is kind of going along okay. The Fed now says that they're not going to reach their inflation target of 2% until probably 2027, and that's 2 years from now. So, originally, Chris, they had said they were not going to cut. They were not going to cut interest rates until they got down to inflation of 2%. Then last year they went ahead and did it anyway. So the Fed's a little chaotic here. They keep kind of changing their mind, and Trump has already said he's not going to reappoint Jerome Powell. So they seem to be. It seems to be like the Fed is a little more political than people would have thought. Um, Now there's some concern that since inflation is not going down, and even if they cut government spending, there's a lot of other inflationary pressure in the system. Then not only will the next rate move not be down, it could actually be up. And that would not be good for the economy. It would be good for savers and investors, of course, because they'd get more on their bonds. But if they were to raise interest rates, obviously that means things are still heating up, it's still inflating, and they need to slow the economy down a little bit, which is what they're trying to do. And that's what they did in 1980, 1981. And the same scenario played out. We mentioned this on previous episodes in the 70s when they did get inflation close to under control, right around where we are right now. And before they got down to 2%, they started lowering rates and it ignited inflation again. And then they had to raise rates. Anybody who was around in 1980, 1981 knows how high rates got. September of 1981 or 16.9% on the Fed funds rate, which is unbelievable. So, we'll see if that happens, and hopefully it doesn't, Chris. But we are now up to 36 trillion in debt, over 36 trillion in debt. So it's something to think about. If interest rates were to go up, then we'd be consuming probably a quarter of all the tax receipts in America just to pay interest on the debt. It was never that much. It was maybe only 5 or 10%. Now it's getting up over 20%. So it wouldn't be a good thing, would it?
No, I mean, and we've talked about that, and that is, there's pressure on the Fed, right, to lower rates because as the US rolls over debt, that's only gonna, that's a boulder rolling downhill, right? It's just gonna continue to gain more momentum as those interest payments get more and more expensive. I think the other thing the Fed's really fighting with is, a lot of the US economy numbers, as you kind of talked about, Brian, have been pretty strong. I mean, earnings, although here and there are misses, have been, I would say, for the most part, stronger than expected. We have good jobs numbers. So the US economy added 256,000 jobs in December, which was way higher than the expectation of 155,000. So over 100,000 over the expectation. So we have kind of this jobs market, which seems to be still holding up. I know there is some slowdown underlying, but I think when you look at leisure, certain underlying sectors that have still held relatively strong, that's kind of backfilling, job losses we've seen in maybe white collar, if you will, job markets. So, and then on top of that, you have consumer confidence. So we saw consumer confidence weaken for the second straight month. It fell not too much, but 5.4 points to 104.1. And that was above expectations. So, confidence is waning a little bit. Job market seems to be holding up, but the housing crisis, I guess we could call it, the housing issue is still there. And I think that's going to be a big, I don't know how the Fed's going to get, because that does impact inflation. Last year, the S&P CoreLogic Case-Shiller National Home Price Index, which is the average price of a house across the US, it rose 3.8% year over year. And that was in November. That's year over year. That was up from a 3.6 year over year number in October. So what does that tell us is that even towards the tail end of the year, home prices were still going, up. They're still growing. So, we continue to have this. And I think on top of that, not only is the price of the home getting more expensive, but we talked about it. I couldn't remember if it was the last podcast or two podcasts ago, but the price of insurance on homes is at extreme highs. And you get in high tax states, such as California, New York, even Illinois, where you have high property taxes, and you have half of your payment just paying for insurance and for a lot of these people that have mortgages. So it makes these mortgages unaffordable for a lot of people. Last year, US existing home sales came in at 4.06 million. So there were only a little over 4 million, if you want to call it, in 2024 existing home sales. That's the lowest level since 1995.
Yeah.
So we still have this big issue of essentially, people can't afford to buy a house. And the crazy thing is, as much as raising interest rates has raised mortgage rates for sure, and we've seen those stay elevated, they're still clocking at about 7% to start the year. We still really haven't seen that choke off the real estate market as people expected.
Yeah. Well, yeah, the real estate market is always a big issue, and it's home formation, and people need a place to live. Of course, they can always rent, but there's about 6 million units available that are not available that should be available, and so the home building market took a breather because the interest rates went up, but it certainly will have a resurgence soon. I bet it will.
Yeah, I
So
mean, the demand's certainly there. I think they just have to look at, from them, obviously interest rates, when you look at insurance, all that. I mean, there's a lot of variables that play into it, but I do think that that's going to be a tough problem to solve necessarily. I think, there will be a portion of it that's solved by you will call capitalism, supply and demand. There is certainly demand there. I guess it's at what point do we have that? Where do they meet that equilibrium? Because it doesn't seem like it's found the equilibrium yet. You have a lot of people that have that demand, but they can't afford it. And you haven't seen the prices of the homes come down yet. So it'll be interesting. I mean, there is going to be an equilibrium met. It's just how we get there.
well, and President Trump is pushing for lower oil prices now. He can't make the market do things, but he can try to pressure other governments because they control their oil, like Saudi Arabia and others, that they can lower prices by increasing supply. And there comes a point where they don't make as much profit, so they don't want to do that. But it looks like they're talking to OPEC, and they're looking for a big part of the inflation that they're looking to bring down is oil prices. Energy is always a very big thing. So we'll see if he's successful doing that. During the previous Trump administration, oil prices did ease, but there's a certain minimum level of profitability that oil prices have to be at. So if it goes down to 20 or 30 a barrel, many of the folks that are drilling are going to lose money. But it certainly would put pressure on Russia because their cost structure is much higher because of the type of crude they have. So we'll see if they're successful at that. Chris, the other interesting thing that's going on, there's been an awful lot of currency manipulation by our trade partners, keeping their rates lower than ours, and causes us, to want to tariff them. That's what at least that's what President Trump says, and that can undo some of those imbalances. The Fed is really unable to lower more because of the government spending that's keeping inflation high, but yet, the tariffs should not cause inflation. Everyone's saying that they should not. But the tariffs should be a lot higher. Now it looks like the tariffs are going in for America, Canada, and Mexico tomorrow. That's the plan. Of course, I think sometimes this president is a bit of bluster, and I think they'll have some last minute discussions about it and see if they can't come to some last minute agreement on it, or within a week of it, or something like that. So we'll see. So that's a newer phenomena. I think he did some tariffs in the previous term, but I think he's obviously looking to do a lot of tariffs now, Chris.
Yeah, it'll be interesting to see. I mean, it's been definitely a headline news. The tariffs, there's been a lot of discussion about it. And I do think, I think a lot of it, the way Trump utilizes them is more of a negotiation tactic.
Yeah.
I think he postures a lot more. We actually saw that with recently with Colombia. He was posturing with sanctions and tariffs for them, with some of the immigration issues, things like that, and eventually he backed off. So I think a lot of that is a posturing, the negotiation tactic to hopefully negotiate better terms for imports and exports.
Yeah. Well, so it's been, Chris, now it's been the better part of 2 weeks since the inaugural, and I was out at the inaugural. I attended one of the three big Trump balls, the Liberty Ball. That was the largest of the three. They had the Commander in Chief ball and the Starlight Ball, and President Trump did get there, but he got there late. And the reason he got there late is he was signing all these executive orders, and that's been kind of the way of operating right now in new administrations. They sign a lot of executive orders. In fact, Jason Aldean was the singer at that event, the country singer, and he said that he had to play more songs because President Trump was still upstairs getting things done. He used the word other than things, but so that was quite interesting. And I think part of the plan is to try to get so many things fixed all at once because there's lots of opposition by the opposition party in Congress that there seem to be overwhelmed almost with all the things that he's doing. And I think Trump, of course, thrives on the chaos. And so we're seeing literally hundreds of things that are changing immediately, if not sooner, with the border and everything else. So a lot of those things will filter through. Some of them are not economic, obviously, and they're more cultural and things like that. But there's a lot of things that are economic that could really help the economy, tighten up budgets and lower spending and things like that. So we'll see. We won't see the results of the changes that President Trump is making in the economy anytime soon, but the markets tend to react to those things sooner than the reality, right? They immediately anticipate it. So as time goes on over the next couple of weeks, we'll hear more and more about the details. I think actually they already signed all these things, but then the media is not picking up on it. And then there's the conservative media, and then the mainstream media, and the mainstream media seems a little bit flat-footed right now, so they're not filling all the stories. And eventually, we'll hear it all, and then the market will probably react to things as the information comes out. Right? It's already been done, already been signed, but as it comes out, that's probably what will happen, Chris. So it's going to be very, very interesting the next couple of months, first 100 days.
Yeah, for sure. I mean, especially as, I think we talked a little bit about, I think some of the uncertainty when you have a new administration, there's always uncertainty there. So, as the new administration settles in, I think markets hopefully will kind of cool down a little bit more. So that volatility will be taken out, and we'll get a clearer picture kind of what things are going to look like for the next 4 years.
Exactly. So other things going on, Chris. President Trump was able to delay whether he gets away with it for too long. Reports will slow him, will clamp down on it. Congressional ruling that TikTok needs to be owned by an American buyer, and so Elon Musk is involved in that. The famous blogger Kevin O'Leary of Shark Tank. So they're all kind of looking at it, trying to figure out how they're going to bid. Maybe they're bidding together. There's all kinds of different proposals out there. But Trump thinks that TikTok helped him win. And so he's trying to keep TikTok and keep it in American hands. So we'll see if that happens. But that's the new way of communicating these days, Chris, is TikTok, Instagram, social media. And of course, there was lots of censorship that was going on. And so now that's been pretty much outlawed. And most of the tech firms are coming on board with the new president and saying they're not going to be doing censoring anymore. So that can change the economics quite a bit, actually. A lot of commerce flows through TikTok, for example. So we'll see how that all plays out. It's going to be more free form, and it'll be interesting to see the impact of it. Russia, however, is in a little bit of a panic. The ruble's been collapsing due to primarily U.S. sanctions on the bank for settlements. So, Russia keeps kind of putting itself in a corner. And then, of course, America obviously is adverse to them at times. And so he's always fighting with Putin, and we'll see what ends up happening there. Chris, as I said, there was new pressure on Russia. We still have all these little wars going on here, and they want to end the wars. And we've been spending enormous sums of money on these wars, and Russia's losing 30,000 troops a month. It's been really an amazing, sad story. But I think they're going to try and find a resolution to that, and that'll lend a lot of the government spending as well.
Yeah, I mean, obviously, I think most people are aware. I mean, the billions of dollars being spent, funding that to a degree, or our part in that, how we fund it. So, that'll be big, and I know that's one of the top agenda items on this new administration. And it seems like, I mean, things have kind of, I don't want to say grinded to a halt, but it seems like things have kind of slowed down a little bit. You just hope that they can come to some type of an agreement.
Yeah, exactly. On one other thing, I think the border is actually affecting the economy quite a bit too, because governments all around the country are being forced to spend, millions and millions of dollars or housing migrants and reopening schools like they did in Chicago. So on the subject of reducing economic chaos, ICE arrested 1,500 people, I think, in the first day, and each one of the ICE offices is supposed to deport 75 people a day. So that's a powerful number, and it's I think 700,000 people that they're going to try and deport right away. And so when they finally get a handle on that, obviously they have to leave and go back to their country. It also does reduce, the cost of all that, and it'll put less pressure on governments and taxation. The birthright citizenship was a big thing, and so that was fueling a lot of that illegal immigration. And they're actually challenging. There's some wording in there. They think will not allow illegals to come in and have children in our country, and that child be a U.S. citizen. So that will really slow down the border and slow down people coming in. And that, of course, that again, I put that in the category of completely chaos, economic chaos. President Trump is also pushing the NATO allies to pay 2%. Now they're talking about trying to get everyone to pay 9% to that alliance, and that's been a big thing for America because we've been fronting most of the money that takes care of NATO. So President Trump is trying to get the other countries to pay their fair share too, and that would be a reduce in our spending as well, Chris.
Yep. Yeah, no, that'll be hopefully big. I mean, these are things that are going to take years and years to kind of evolve out. But obviously could have big effects, big impacts.
Excellent. Well, good. I think that's all I have for today, Chris.
Yeah, no, I think that about covers it for for this week, for the tail end of January.
Excellent. Well, there's a leadership matrix blogs, if you would. So if you go on to the 4starwealth.com site, everyone, there are different blogs where many of our advisors put out interesting comments, economic comments, and you can sign up for any of those newsletters. I host the leadership matrix blog, and there's a number of really interesting things about the economy and different things that are happening, and things about the administration as well. So have a look at the leadership matrix. And then, of course, there's tons of different podcast interviews that are on there. We're going to be doing a couple of interviews with different players in the economic system this year as we get into it. So people that might be interesting to invest with. So we're going to be talking to some of those folks there, Chris. And what else would you have today? Anything?
No, I think that covers it. For the end of July or end of July, January podcast.
Yeah. Well, great, everybody. Well, thanks for being with us today on our January 31st episode. We'll be back in February. We've talked for years about how our podcast has been very, very popular, and we're ranked in the top 1% of all financial podcasts in America. We're very proud of that. So please keep telling your friends and keep getting people involved. I'm hoping I will be in Antarctica soon. And we've talked about how we've been heard on 6 continents, but never Antarctica. So we might actually tape an episode where I'm in Antarctica. Could be very interesting. So hopefully we can do that later this month. And we'll come back to you on the next episode, and it might be from Antarctica. We'll see. Thanks, everybody, for being with us. And thanks, Chris. Thanks, everybody. And we'll leave it here. Over and out. 4-Star, today's Market Explained podcast. We'll be back again with another episode very shortly. Thank you very much.